Every major crisis follows the same script. Shock hits the system. Markets panic. Governments rush in with emergency spending. Central banks step up. And afterward, we're told the worst is over. But look closer. Why does every crisis leave behind more debt than the last one? Why is emergency borrowing never reversed once the danger passes? And why do governments now seem to need crises to justify policies that would otherwise be impossible? Here is the uncomfortable mystery most people never examine. Crises don't break the system. They activate it. Somewhere beneath elections, headlines, and speeches, there exists a quiet machine, a mechanism that converts fear into borrowing and borrowing into permanence. Today, we are opening that machine. For most of history, crises were destructive but cleansing. Wars bankrupted empires, plagues wiped out debts. Financial collapses erased bad promises, along with bad actors. Debt was fragile because money was constrained. If a government overborrowed, lenders demanded repayment in real assets. If repayment failed, defaults happened. Reputations were destroyed. This was painful, but it enforced limits. The turning point came when governments and financiers realized something revolutionary. What if crises could be used not to destroy debt, but to expand it? What if instability could be monetized? That idea changed everything. Origins: war, banks, and the first emergency loans. The machine begins in wartime. In the 17th and 18th centuries, European states faced a brutal reality. Modern wars were too expensive for taxation alone. So governments borrowed. At first, these loans were framed as temporary, just until the war ends. But wars ended. Debt did not. Why? Because lenders discovered something critical. Governments in crisis will accept any terms to survive.
Nice.
This gave birth to permanent sovereign debt markets. The Bank of England, founded in 1694, was not just a bank, it was an early version of the machine. War created urgency, urgency justified borrowing, borrowing created long-term interest streams, crisis became profitable. When emergency became palace wife, fast forward to the 20th century. 2 world wars, institutionalized crisis, finance. Governments learned that. Citizens tolerate massive debt during emergencies. Central banks can suppress interest rates. Inflation quietly redistributes costs after World War II. Something subtle happened. Emergency measures never fully ended. Temporary programs became permanent institutions. Crisis powers stayed in place just in case. And with the abandonment of the gold standard, the machine accelerated. Now debt had no hard ceiling. Crises were no longer interruptions to normal policy. They became the justification for expanding it. How the machine works step by step of this is the core mechanism. Shock: a war, recession, pandemic, or financial collapse. Fear: markets seize, unemployment rises, confidence falls. Emergency: authority, governments bypass resistance, spending limits vanish. Central bank intervention: interest rates drop, asset purchases begin. Debt expansion: borrowing explodes, framed as temporary. Normalization: the crisis ends, the debt remains. Dependency: the system now requires higher debt levels to function. The key insight: debt added during crises is never removed because removing it would cause another crisis. The machine feeds itself. By the late 20th century, crises were arriving faster. 1970s inflation, 1987 crash, 1997 Asian crisis, 2000 dot-com bust, 2008 global financial crisis. Each time, the response was larger. Each time, the debt baseline ratcheted upward. After 2008, something unprecedented happened. Central banks stopped pretending interventions were temporary. Quantitative easing, once unthinkable, became routine. Debt markets were no longer just supported, they were propped up. This was the moment the machine became permanent. Why debt can never go back. Dabian, here's the trap. Fragility makes policymakers fearful. Fear prevents tightening or repayment, so debt becomes untouchable. Governments cannot raise rates without crashing markets. They cannot cut spending without recession. They cannot default without systemic collapse. Every option reinforces dependence on the machine. Debt stops being a problem to solve. It becomes a condition to manage. Failed fixes. Why nothing ever works. every proposed solution fails for the same reason. Austerity reduces growth, worsens debt ratios. Growth strategies require stimulus, which adds more debt. Inflation erodes trust, forces higher interest rates later. Debt restructuring triggers panic and contagion. The machine is designed to absorb reform attempts and convert them into justification for further intervention. The system is not broken, it is functioning as designed. Modern parallels. The pattern pal look at recent history. The 2008 crisis justified trillions in rescue programs. None were unwound. The pandemic justified unprecedented borrowing. Debt levels permanently reset higher. Today, global debt exceeds 3 times global GDP. Central banks hold massive government bond portfolios interest. Payments rival social spending. Crises now arrive before recovery is complete. Why? Because the system needs continuous justification to maintain itself. The machine cannot stop. The deeper truth why this is politically INVI, SIBL, no one votes for permanent debt, but everyone votes for stability. The machine operates quietly because costs are delayed. Blame is diffuse. Benefits are immediate. Debt allows governments to promise everything without confronting trade-offs. In crises, provide moral cover. Extraordinary times justify extraordinary measures every time. 3 clear TAKOTAAI. A takeaway 1. Crises are no longer disruptions. They are fuel. Takeaway 2. Debt added in emergencies becomes structural, not temporary. Takeaway 3. The system depends on fear to function smoothly. The machine assumes one thing above all else, that confidence will always return. But confidence is not infinite. What happens when the next crisis arrives before trust has recovered? What happens when debt itself becomes the shock? That is the question policymakers cannot answer, because the machine has never learned how to stop. If this analysis changed how you see crises, debt, or government power, you're already thinking ahead of the headlines. Subscribe for deeper examinations of financial systems, hidden mechanisms, and historical patterns. Because the most dangerous machines aren't loud, they're quiet and they run on fear.